Assalamu alaikum wa rahmatullahi wa barakatuh. Dear students, I hope that your evening is okay and that your week is going as per planned, and hopefully that we shall have a lecture tonight about the sixth topic, and that is to do with the insurance intermediaries. Why I have organized this lecture is because I think we have missed some weeks, and because of that it would be necessarily warranted that we have this lecture. And my hope is that after this lecture we may have one more lecture, and hopefully it will be this weekend, and then maybe you're left some time to revise. So basically we are having this lecture in order to cover up at least some of the things that we missed or that we should have covered that we did not cover due to reasons beyond us. So you are most welcome to the lecture. Sorry for that, I have some cough kind of thing, so it disturbs me. So we are going to look at the topic of insurance intermediaries, but before that we are going to first look at some relevant terms as far as insurance intermediary is concerned. And one of those terms is market. What I can tell us is that like any other industry or like any other market, insurance market also exists in that manner, in a way that in it there are buyers and there are sellers. So a market cannot exist if there are no buyers and no sellers. It ceases to be called a market. So what we're saying is that a market is the public trade of buying and selling products and services. And as such, the insurance market is a free market. So in the insurance market, there's selling of services, there's exchange of services. And when it comes to replacing a lost property, there's exchange of goods involved in it. And we are saying it's a free market because as long as an investor has met the legal requirements to have an insurance company, they are free, they have free entry. And as for those who think they are not making to their expectations, they also have a free exit. That means they can leave the market at the time they want. This is a free market, also in a way that it is controlled by the forces of demand and supply. So where there is demand, of course, the services are expected to come in of insurance, but where there's low demand, also it affects the entry of such insurance companies or firms. So for the case of Uganda, you'll find that the demand for insurance services is low, though it is growing, but that does not neglect the fact that it is at its, I would say, initial stages. And that's why it's not common among the common man, or men, if I can use that one. So we have that challenge in Uganda of still trying to create awareness, educate people about the importance of the insurance. Of course, in this market, it is also being regulated. The insurance market is being regulated. Just like any other market, financial markets are regulated, the insurance market is regulated, and any other market that may exist out there. They're all regulated. So for that, we have in Uganda, we have the IRA, Uganda, that is Insurance Regulatory Authority of Uganda. So they are regulated by the relevant frameworks, and then supervised also by the government. The government is like the general supervisor. So simply, an insurance market could mean the buying and selling of insurance, and we're saying it includes the entities involved in the process as well as the customers. So the market exists, and that's why you see people are doing their part. Everybody is trying their best to make sure they sell. And as I said, in the market, there's always selling and there's buying. And that's why we're saying it is the buying and selling of insurance services. Another term that I wanted us to look at is what we call as reinsurance. Reinsurance. The term reinsurance refers to a contract between an insurance company and another insurance company. So under this term, we are learning that an insurance company can actually insure some of the risks that it has insured with another insurance company. And in that case, that insurance company that is insuring another, we call it the reinsurer. The reinsurer. Then the one that is getting insured or getting some of its risks that it insured to be insured by another insurance company is what we call as the cedent. I hope that is clear. So in short, the insurance of the risk assumed by an insurer, that is to say, the insurance of insurance. So it's an agreement whereby one insurance company called the cedent transfers to another insurance company called the reinsurer all or part of its risks, and the latter receives a portion of the premium. Depending on the agreement, it could be that they are sharing the risk in a way that part of it is catered for by the first company, and part of it could be covered by the reinsurance company. So in that case, they would share the what? The portion of the money that is received by the first company, the one we call as the premium, the monies that people pay, whether annually or monthly, the premium amount that they pay for the services of insurance. So why do companies do this? It is possible that some of them might lack that capacity fearing that in case such an event occurs, it could be too huge for the company to handle alone. So in such a case, they tend to like form a kind of partnership, or give it all to the what? To the reinsurance company. So it is necessary for insurance companies to have similar risks in order to guarantee their stability, and for this reason they share or cede a part of their insured assets with other companies. These mechanisms make the operation of insurance companies more robust and give policyholders peace of mind. Of course, the policyholders may not have peace of mind the time the event occurs and the insurance company is not able to fulfill the obligations of reinstating the insured. Then there will be no peace for sure. But where it is able to cater for some, and then another company also comes into also to cater for the other part, then in that way it can be of use. So that is in reinsurance basically, where the insurance company again insures with another insurance company the assets, or the assets that it had insured for other companies, or the insureds, I mean. We also have a term called double insurance. So when we talk about the double insurance, we mean that a situation when the policyholder gets the same risk and subject matter covered by more than one insurance company. So you'll find that there are people, companies, who could engage in such activity, of course, of insuring with different companies, more than one at least, for it to be, actually, more than one, or should be two, for it to qualify to be what? Double insurance. Of course, the word double means two or twice. So the companies may decide to register, to insure a property with one company, and also does the same for the same item with another insurance company. What it implies is that it is paying premiums to two insurance bodies or two insurance firms. So in the event that a loss occurs, he is expecting to be paid, or to be refunded, or to be reinstated back twice. In other words, the two companies, if it's a car, the two companies are supposed to replace two cars. And we are told that reinsurance and double insurance, one of it is allowed or is legal, and the other is actually illegal, or maybe I should not use the word illegal, but it's not allowed, because under the principles of insurance, we have that you are supposed to just be reinstated to your initial position. But in this case where there is double insurance, the insured may hope to benefit from the two insurance companies, meaning he hopes to get benefit from the two insurance companies. If it's a car, if it's replacing it, then he hopes to get the two cars. But remember, we're saying we get insured not to make profits. It looks unfair because for the insurance company, they can actually make profits. They are business oriented. But for you who is getting insured, you are not meant to get profit, but you are meant to be reinstated to your initial position before the event or the the fateful event occurred. So we learned that because of that, in double insurance, the person is hoping to get extra benefit than the state at which he was in before. So that makes it not allowed, and that makes it not to follow the principles that we learned, that insurance exists to take someone back to his or her initial position, or a company back to their initial position. So those are the basic terms that I wished that we understand them and probably pick something from there. The second area I wish us to look at is the players in the insurance market. The players in the insurance market. All markets have their players. They have players in the market, and just like they have players in the market, the insurance company or the insurance industry or sector also has the players. And the following are actually the players. They are not something unique. They're something that you should be able to grasp at the first point. Even without this lecture, I believe with the notes, you would be able to grasp them very fast. And without wasting time, one of them is the sellers of insurance. The sellers of insurance. As we already know, in the insurance industry, it has its sellers, and basically they are the individuals or organizations or firms that engage in the business of insurance. In other words, they sell their products, they sell their services to their clients. So this basically concerns the insurance companies, or I would say the insurers. Hope we are together. The insurers are the what? The sellers of the insurance services. And there are many insurance companies in Uganda. Maybe I will try to send for you a list of those insurance companies, specifically those in Uganda, and maybe furthermore you may find out about what actually they do, and therefore be able to advise wherever you work, your company or your stakeholders of where you are working, to be able to select the one that has the best offer. And that's the advantage of the class. It's very practical. It gives you information that you really need to, in the current world, that you really need. As I talk, actually you'll find that all organizations, in one way or another, they insured. Either it is their properties or it is their employees for health and so on and so forth. So in one way or another, they are using the services of insurance, and that's one way of showing that the industry is growing. So in the sellers, we have two categories, and these are basically they are classified into proprietary sellers and those called the specialists. So for the proprietary companies in the insurance business, these are actually the ones that engage in the business of insurance to earn profits. In other words, such companies have shareholders, and these shareholders, they expect at point T to get a benefit from their investments. And that means that usually the organizations or the firms, the insurance companies, pay part of their profit to these shareholders or the owners of the what? The insurance company. So that part which is given out, we don't call it we have given profit, but the correct term we use is that we say they are dividends. So the insurance company gives dividends for its shareholders. So when also the company is not able to run itself, of course, it is wound up. In the normal ways, the company would be brought to an end. We also have another type of the insurance company that we call as specialist companies. Basically, specialist companies are those insurance companies that specialize in one product, in providing one kind of service. They become specialists and actually maybe better than the ones who provide generally. And that's why they are called specialists. That means they have a specialization, they have an expertise in providing a particular kind of insurance service. And that could be doing only insurance, insuring lives, life insurance. It could be health insurance only. It could be about auto insurance only, and so forth and so on. So we have very many companies or insurance companies. These are the sellers, and some of them could be UAP, as I've listed some of them here. Alliance Africa General Insurance Limited, Statewide Insurance Company, National Insurance Company, Sanlam, Jubilee, and so on and so forth. So there are many. As I said, maybe I will try and share with you the list that I have of these insurance companies, so that you can be able to research about them, how good their services are, and be able to advise your company on the best of the insurance companies. The second player in the insurance market is the buyers of insurance. And when we talk about the buyers of insurance, as I said, these things we know them, but we want to bring them to your attention so that you are reminded that that also in the insurance company there exists such kind of players. So we shall find that the buyers of insurance are actually individuals. They could be individuals, they could be organizations that usually purchase the insurance services from the sellers, from the insurance companies, for their personal use and property. For example, insurance for their motor vehicles and for their personal accidents. However, sometimes the commercial insurance buyers comprise of the biggest percentage of the buyers of insurance services, such as governmental organizations and parastatal bodies. That is understandable. Or large organizations, they are actually one of the biggest buyers of these insurance services. And you'll find that all government properties actually have to be insured. Otherwise, it is a bigger risk not to insure them. And you'll find also that most of the organizations or companies, their properties are actually insured. And you also find that at this time or these days, you'll find the police on the roads trying to enforce that people must have what? Insurance license. So in fact, when they arrest or the traffic arrest you, maybe for an accident, when you go there, the issue may not be the accident. The issue may be that you don't have a helmet, you are riding without a helmet, the issue may be that you don't have insurance, you're not insured, so you want to cause problem for the government, and so on and so forth. So different issues may come there. So you will find that even the government itself is enforcing that some of these items that we own are actually insured. So that's what we are talking of, the commercial. In commercial, it is always their interest is profit, and therefore when the uncertain event, which is unfavorable, occurs, that could be a big loss, you know. But with insurance, you are insured. So your future is insured. Your company's future is insured. The other player in the market is what we term as the service providers. When we talk of the service providers, they mainly provide services on behalf of the insurers, meaning the insurance companies, and they mainly include risk managers and loss adjusters. Though sometimes they also include the surveyors for, as they say, technical services. So these people provide some particular kind of service basically on behalf of the insurance company. They do some job or some work for the insurance company. A consultancy, basically I will talk of consultancy work for the service, the insurance companies. And as I said before, one of it is the risk managers. We're saying these are those managers who usually involve themselves in the identification of the risks, controlling of the risks, and measuring of the risks, as well as advising the insureds about the pre-minimization measures of controlling the risks. So risk managers, basically, their work is to assess, evaluate the risks that the insurance company is going to insure their clients against, and their likelihood of occurrence, and how they will adversely maybe impact the client, and therefore see a way through to have favorable terms with the insurance company. We're also saying that sometimes they also advise the insureds about the pre-minimization measures of controlling the risks. They can also advise, of course, the clients of this company, the insurance company. For example, IUIU is a client of one of the insurance companies. It used to be AIG insurance company, and then there could be service providers, their service providers who come to advise us about what to do, how to identify more risks, or how to identify the risks that exist, how could we avoid these risks, or how could we minimize their occurrence or their impact, and so on. So they advise on that basis. We also have the loss adjusters under the service providers. We're saying these are professionals qualified in assessing the magnitude and the cause of the loss. So, of course, loss adjusters are also service providers. They come after the loss has occurred. As I said, they do the work on behalf of the insurance company. And their work is to be able to assess, to evaluate the causes of the event or the accident, whatever it could be. And of course, the cause of that loss, the magnitude and the cause of the loss. And on that basis, of course, they make reports to the insurance company, okay, about their findings. So they will make a comprehensive report and submit to the insurers, and further negotiate with the insurers on the ways of settling the claims of the insurers. Of course, they use now their expertise to advise on how the claimants could possibly be compensated or paid back. We also have the risk advisor. We're saying the risk advisor refers to a person who, by way of business, assesses and advises on the insurable risks. Dear colleagues, dear students, not all risks can be insured. As we learned before about the nature or the characteristics of insurable risks, if the risk does not fall within what we would define as insurable, then it will be out or it will not be insured. So when it comes to assessing and advising on insurable risks, it is to do with whether, as per the principles, whether there's an insurable interest that the client wants to insure against. Whether there's what? An interest that exists that needs to be insured. As I said, that whatever you are insuring must have value. It must have value to you. For example, the insurance company may determine that your house that is dilapidated and has actually crumbled down as something that cannot be insured. It is not an insurable risk. Why? Because what is your interest in that house? Because these are the gateways for people to fail with their obligations. They may even fail to pay the premiums because maybe they will realize that later on that this house has no value, so why should I keep paying for it? Yet, the other question would be whether the insurance company, in case of another uncertain event, that it can bring the dilapidated house to that state again, which is, of course, is not possible. So it becomes an insurable risk. Then we have situations where a company may, okay, not a company, an individual may want to insure, I mean. Anyway, the question is, do you think it is an insurable risk to insure yourself against death? So it is not what? That's not an insurable risk. The insurance company cannot insure that. Not only that, the risk advisor actually comes to find out, according to our capacity, what can we provide for this client? If we find that what he wants is not within what we provide, then it's not insurable for us also in that way. The question is also, can you insure a dead body? The question is whether it has value. I know we are religious, we will say it has value. But business-wise, it has no value. So therefore, it cannot be insured because we don't see that interest. We don't see the benefit that you may get from the dead body, insuring the dead body. After all, what are you insuring the dead body again from what? So, Those are some of the service providers. And another player, which is the fourth player that we want to see, is actually the intermediaries of insurance. And this was the name of the topic in the course outline. So when we talk about intermediaries, I would also say this, that intermediaries exist everywhere. As long as there's trade, there are intermediaries. As long as there's buying and selling, there are intermediaries. As long as there's production, active production taking place, there must be an intermediary. And so, therefore, we're saying that the intermediary is a necessary link between the buyers and sellers of insurance. So the intermediaries are a bridge between the sellers and the buyers. As a matter of fact, most times individuals or companies or clients go through the intermediaries. If I would bring the example of MTN, if somebody hoped to buy shares from MTN, you don't necessarily need to reach headquarters in Kampala to buy shares, because they have their intermediaries in Arua, so you could reach them and they give you all the consultancy services, advising you which one is best for you and so on, or how much shares you can buy, at what rate, how do you buy them. They're able to provide for you those services. And just like that, insurance also has those intermediaries who are able to offer such crucial information to the potential clients or potential insureds. So we're saying that insurance may sometimes be bought directly or through intermediaries indirectly. So both ways they work. You can buy directly from the insurance company, but you can also go through the intermediaries, depending on, of course, your state of affairs, your interests, of course. So an intermediary is an individual who acts as a mediator or middleman between the insurance company and the insured. They serve as a bridge between consumers and insurance companies. So according to the Insurance Act of Uganda, insurance intermediary means an insurance agent, an insurance broker, a risk advisor, a loss assessor, a third-party administrator, or a reinsurance broker. So the Act of Uganda, the Insurance Act, has actually listed these people or these intermediaries. But for our case, we are going to look at least 4 of them out of the ones they have provided. I think reinsurance broker already, that time we have already seen it. And so we are going to look at some of those basic intermediaries. And of course, the first one being the insurance agents. Insurance agents. Insurance agent. And we're saying that an insurance agent is a professional who sells an insurance company's products to consumers to earn a commission. I hope this is easy to grasp. I would bring the example of, you see, these mobile money agents. Those are a good example of agents. And you also find that insurance agents earn commissions, of course, just like the MTN agents or Airtel agents also earn what? Commissions. So we are going to say that insurance agent means a person appointed and authorized by an insurer. So an agent is appointed, first of all, and then authorized by who? By the insurance company to act on their behalf. To act on the behalf of the insurance company. From authority from the same insurance company. And the main aim is to solicit for applicants. Of course, look for clients. I don't know whether they've ever seen, they have ever tried to look for clients. They even go to companies and offer you their brochures or provide you with the required or necessary information about their company and what they do, how they do it, and so on, and how they are better. So they have that authorization from the what? From the insurers to solicit for applications for the insurance company. And they also negotiate insurance coverage on behalf of the insurer or perform other functions of an insurance nature that may be assigned to him or her by the insurer, and who, in consideration for his or her services, receives commission or other remuneration from the insurer. Of course, it depends on the types. Mostly what we know is that insurance agents receive commission, but sometimes even they act as employees of the insurance company, and therefore they are paid salary or wages for that purpose. So an insurance agent also is a representative who sells the policy on behalf of an insurance company. In other words, as per the terms, is able to market and sell it out to a client, and in that way, by the authority that he's able to sell those things to another party, that means he is already implied that he or the person selling is an agent. So the insurance agents, they are not independent. They get their authority from the insurance company or their employer, I would say, if I may use that word. And whatever they are to do must be within the guidelines, must be within the contractual agreements with the insurance company, nothing out of it. Otherwise, they are liable for whatever they do, not the insurance company. So they act on behalf of another. So when we talk of agency, we mean one person acting on behalf of another. And the person acting on behalf of another derives his authority from what we call as the principal. So in the agent relationship, we have the agent and we have the principal. Of course, the agent being this person who derives his authority from the principal. And the principal is actually the insurer. And in this case, the agent is the intermediary. And that's why we call the agent as a representative in one of the paragraphs, as a representative. The agent could also help consumers or the clients on how to select the right insurance based on their needs. Of course, we have different needs of what we want, advising on which one fits best you, but represents an insurance company. Remember, the agent is a representative of the insurance company. So in common, there are two types of agents. One is the independent agent, and the second is the exclusive or the captive agent. And when we talk of the independent agent, these are those that have that can actually deal with any other, that are able to deal with more than one insurance company. In other words, they can help to solicit for applicants for different companies. Just like if we are in your shop and you're an agent, you can become an agent of mobile money, you can become an agent of Airtel money, you can become a mobile banking agent for Stanbic or DFCU or what, in that manner. That would qualify you to be an independent agent. Then we have the exclusive or the captive agent, and this one specifically deals in the product of one insurance company. So independent agents, I mean the exclusive agents, are one who are exclusively deployed for the sales of insurance policies of one company. Their commission can be in the form of salary, or they could get both commission and salary. Of course, we know they could be getting their commission from getting new clients. If you get a new client, it's a commission. It could be renewing the contracts of insurance. If the clients that they brought are able to renew their insurance policies again, then that could be also a form of earning a commission. So that is the agent or the insurance agent. Then we also have the insurance broker. Now be careful here, because they are like the same almost, but we shall at point T see the differences. So we're saying that an insurance broker means a person licensed by Insurance Regulatory Authority of Uganda who arranges insurance contracts with the insurance companies on behalf of clients. So like the agent, the insurance broker also organizes or arranges for contracts on behalf of the clients. Take note. So an insurance broker may represent more than one insurance company, just like an agent also. Insurance broker may also mean a person, not being an agent. So is not an agent, but acting as an independent contractor for a commission or remuneration negotiates or arranges insurance contracts. So any person who is not an agent, but arranges or negotiates insurance contracts and is not also an insurance company is actually what we call as a broker. As we shall see in the differences between the insurance agent and the insurance broker. Remember, we have looked at two terms. I mean the two intermediaries. One is the agent, who acts on behalf of the insurance company and derives his authority from the insurance company. Then we shall also look, we have also looked at the insurance broker, and we said also arranges for insurance contracts on behalf of the clients. So we want to look at some of the key differences that exist between a broker and an insurance agent, because they really look to be the same. So one of the differences that exists between an agent and a broker is who they represent, whom they represent. or their representation. Remember, in what I've explained before, I had said that the insurance agent acts on behalf of the insurance company. The insurance agent represents the interests mostly of the insurance company, not the clients. Its duty is to represent those interests to the clients and sell those interests to the what? To the clients. But on the other hand, the broker represents the client. Somebody is going to ask how, but that is how it is. The broker represents the clients. So mostly it is these large organizations or large groups that go for brokers. The reason is that the brokers speak or they do their things considering the interest of the client, and therefore advising them on the best alternatives to choose. Not only that, the insurance broker helps to negotiate the insurance contract on behalf of the client in terms of the premiums to pay, how much they are supposed to pay for the services of the insurance. So they have that capacity to purchase the insurance services at lower prices than the other intermediaries or the agents, basically. Because the agents have their terms prescribed. This is the price of this one, this is the price of that. But for the brokers, they're able to negotiate with the insurance companies favorable terms on behalf of or for their clients. So that's one huge difference that we can get from here. And the second one is the remuneration, or how they earn, how the insurance agent earns, and how the insurance broker earns. And we're saying that when it comes to remuneration, the agent basically depends on the commission that they make. Just like the mobile money agent entirely benefits nothing from MTN, except that it benefits the MTN and then benefits from the transactions it has carried. So the agent of insurance is supposed to benefit in that manner from commission. You do business, you get commission. You reach a certain number, you get extra commission. You're able to retain or make people renew their contracts, commission, depending on what they agree. And as I said, the exclusive, those types could also even be getting salaries from the what? The insurance companies. However, for the insurance broker, he gets his money or his benefits through what we call as brokerage, from the word broker, brokerage. And that term is similar, or it is used in a similar way the word commission is used. So somebody will say they are the same. I agree. They are all commission. But for the brokerage, for the broker, it's called brokerage. Meaning that any business deals that he does, he also gets what? The brokerage or the commission. The difference comes here in a way that the remuneration of the agent comes from the transactions that he carries on behalf of the insurance agent. So in other words, the insurance agent pays him the commission. But in the case of the broker, he is not paid by the insurance company. If the insurance broker does that, then, or if they are paid, or if any insurance company decides to do that, that could qualify to be called bribery. Because these brokers may be dealing with different insurance companies, and if one insurance company decides to pay him, he may decide to direct business towards that one who is bringing more business. I mean, benefiting him more. And this could sometimes be against the will of the clients. Because he's paid, then he does that. So that will not be okay. So basically, the brokers get their remuneration, they get their brokerage, they get their commission from the clients. So the clients are the ones who pays the what? The brokers. Whereas the agents are paid by the insurance companies. So that's also a huge difference that exists between the two. We also have another area that we could use to distinguish between the agents and brokers of insurance, and that area is to do with accountability. As a matter of fact, the insurance agents are only accountable to their employers. I mean the insurance companies. For their actions, they are only accountable to the insurance company. So, anything the insurance agent or the agent does is, as we said, on behalf of the company. Whether things go well or they go bad, they are done on behalf of the insurance company. And therefore, to the authority, to the regulatory authority, or to the government, the insurance company is responsible or is accountable on behalf of the agents that it employs or that it has. So if anything goes wrong, the insurance company is charged for the misconduct, and therefore they are liable for the misconduct of their client, of their agents, of their what? Agents. And that's the reason why you'll find that they usually invest in the agents by training them, sometimes give them tools of work, because they are actually doing what the insurance company, they are the ones doing what the insurance company is supposed to do. So they use the agents to do their work. When it comes to a broker, of course, all this, whether you're an agent or you are a broker, you must be registered. You must be registered under the IRA, Insurance Regulatory Authority. You must be able to what? Register. They have the forms, and you can get them actually when you download the Insurance Regulatory Authority document or policies. You'll be able to see what I'm talking about. So the insurance broker is independent in a way that if anything goes wrong, if it gives a misinformation, that has turned out to be catastrophic, then the insurance company is not responsible if they misrepresented information of the insurance company to the client and it has resulted to an event. Then the insurance company is not responsible. By itself, as the broker, they are responsible. And these brokers, usually, we're not talking of individuals, they are large companies by sometimes. Of course, they can also be small organizations, the brokers. So take note that the agents are accountable to the insurance companies, but not to the government or the regulatory body. I mean, at that level of where a liability arises because of misinformation. For example, an agent happens to give a wrong information. They are responsible to what? Or accountable to the insurance agent. But for the brokers, for their misconduct, they are held accountable by the regulatory authority or the government. So I wanted us to look at that as also an area of difference. So those are the differences that exist between the two types of intermediaries, basically the agents and the brokers. Another type of intermediary, or an intermediary, is what we call as the surveyors, or the surveyors and loss assessors. We're not going to waste much time on this one. As we said, that when we talk about the surveyors, they usually assess the disaster and they evaluate the financial loss to the insurer. On which basis of their evaluation, the insurance company makes a financial assistance by indemnifying the insured back to his original state. This could be the same as maybe loss assessors. They could be the same in that way, that they are all, or they involve themselves in assessing loss to the insurer and evaluating the evaluating the insurance company makes a financial assistance. Okay, based on their evaluation, then the insurance company can pay the what? The insured. And for loss assessors, is a person licensed under the Insurance Act of Uganda to undertake the business of assessing and investigating losses on behalf of an insured, or actually an insurer or insured. So this one can do the work for both parties. It could be that is doing it on behalf of the insurer or on behalf of the insured. So loss assessor means a person licensed under the Insurance Act of Uganda to undertake the business of assessing and investigating losses on behalf of any insurer or insured. The surveyor usually assesses the disaster and evaluates the financial loss to the insurer. This one is on one-sided to the on the side of the insurer. In other words, acts on behalf of the insurer. So they look for the actual cause of the accidents, and they have to behave and act like ambassadors on behalf of the insurers. Furthermore, the surveyors are supposed to prepare a concise but comprehensive report to the insurer, stating therein all necessary material facts as regards the cause of the loss, degree of moral hazard, and assessment of the loss in terms of finances, so as to enable the insurer to indemnify the insured. So those are the surveyors and loss assessor. As their name, basically they deal with investigating the situation in terms of what caused it, in terms of how much loss has been caused, and therefore making recommendations, written recommendations on how to pay or to indemnify the what? The insured. We have something, the last one, called the third party administrators. We have the third party administrators. We're saying third party administrator refers to a person who provides services to an HMO or a licensed insurer in relation to the administration of health benefit plans or health insurance policies. So the third party administrators, their work is basically to help the insurance companies in terms of administering or administration of certain services, especially services related to health. Services related to health. In other words, health insurance, managing health insurance. For example, insurance companies insure against health. So we have health insurance. But it's not a must, or it's not necessary that this insurance company has a hospital or has a health facility, or that they have the capacity to manage it. You know, insurance, life insurance, health insurance, issues to do with health is not easy to manage. So they get these organizations or groups called third parties to handle or to help them in managing such health-related issues. Basically, they are related to health. So a healthcare third-party administrator provides an insurance company with a wide range of services like network management. Of course, insurance companies may have the services across. You may have insurance company in Arua, and you have people who have registered here. And how are they supposed to get their services? In case they become ill, how do they access the services? So you need the service of the third parties to help you manage all these facilities, maybe health facilities. In terms of administration, basically, pre-authorization, like before somebody is treated, it needs to be ascertained that for sure there's what? Somebody is sick. That needs to be ascertained. So there must be somebody or a group that is able to authorize that this is realistic and therefore may need to be attended to. Otherwise, it could be subjected to fraud, whereby the health personnel could connive with these clients and defraud the insurance company in a way by maybe hiking prices, or in a way that claims that the insurance, the insured actually got more services when actually the only time the person was sick was once in a year. But now you have 100 claims by the health facility providing that service. So therefore, the third-party administration becomes very necessary, and that's why the third parties actually become an intermediary in that sense, because they have a part to play. But take note, the two, the surveyors, loss assessors, and the third-party administrators are not the same as the insurance broker and the insurance agent, in a way that for the insurance agents, they are engaged in marketing, in selling the products of insurance, and for the two, they are not engaged in marketing of insurance or procurement of insurance business. In other words, they don't look for clients for or on behalf of the insurance company. Instead, they help the insurance companies to do some administrative work, operational work, and so on. So that is the third-party administrator. Now we want to look at the insurance sector regulation. As we said before, that the insurance sector, actually the regulatory authority, is one of the key players that I've not talked about. I've not put for you in the notes, though I'm talking about it. It's a player because it is affected and it affects the business of insurance. So when we talk about the insurance sector regulation, we are talking about the laws, the rules that govern the business of insurance. In other words, it is very necessary where trading, an activity of trading or a market is involved, that it has to be regulated by a body, and that body must actually have actual authority. Otherwise, it cannot be controlled in terms of misuse of the insurance business or the insurance sector. So we are saying that in many situations, businesses and individuals are risk averse. This means that they would prefer to pay some amount of money to reduce the amount of uncertainty in a situation. It would therefore be mandatory to protect the business of insurance through rules and laws that govern the business by protecting the interest of both the insurers and the insureds. So why the regulatory authority is there is, one, to ensure the continuity of the business of insurance, that it is there because, as we know, it has benefits for our economy, as we looked at the benefits of insurance. We also know that it has benefit to the insurance company. In other words, it can protect the insurance company from fraudulent activities by other parties or the insureds. It also helps the insureds. Okay? It also helps the insureds in a way that it is able to give requirements for business operations. It is able to give requirements that when a claimant puts their claims for refund or for payment, then the insurance agent must be able to act within certain period of time. And such things, they are really of benefit. And the issue of cheating basically does not arise. And as I said, the business continues in a way that is beneficial to the government, to the community, to the insurance company, to the business owner, and the state at large. So, it is there to ensure safety, financial stability, and that ethical practice in the insurance sector is what? Regulated. So the business is being regulated. So in the regulation, what are the common areas they look at, or the regulation looks at? One is that insurance firms are frequently obliged to seek a license or registration from the regulatory body. And for our case, of course, in Uganda, it's the IRA, Insurance Regulatory Authority. So the question is, why must they seek for a license or registration? You know, you cannot come into business and just do business. That would put in danger the other parties in case you have a bad faith to conduct the business. And that's why the insurance companies are required to register and have a license of operation. Otherwise, we would not be sure of those who are serious in the business and those who have come to defraud the people or the state. Such situations are there. Insurance company may come, if there are no clear guidelines, they may come after collecting your money, they disappear. The example I can give is not an insurance company, but there are groups of people, what they are called Gold Star, or about what. What they do, they make people pay money to them. They register and pay some money. So once you pay that money, you become like their agent, and then you're supposed to make sure people register. You attract more business for them, and they are going to pay the money maybe that you paid, or more or less, and they register under you. So as they register under you, you earn something like, it's a kind of like commission. So the more you bring, the more commission you earn. So the tree grows in a way that you'll have very many people under you. Maybe the first 2 people, you have them in the names of furniture. Another one is called carpenter. Another one is called furniture. So under furniture, as the furniture looks for more clients like chair and table, the other client tree looks for mahogany and another type of tree. And this tree, it grows. I'm talking of human beings. I'm not talking of the trees. Take note. I'm just using them as an example. So as more you grow your wings, if I may use the term, the more commission you will earn. And in fact, some people earn more money that at point T, others were able to benefit from that, but others were not able to benefit, because every time they get their commission, they say no, they sit there, maybe 100 million, but they say let it grow more. So one time these people just disappear, and actually they have ever disappeared, and the people have entered in losses. So the regulation comes there to make sure that insurance companies don't do the same. It doesn't happen with them, because basically they collect your money and they don't provide the benefit immediately, not until actually the loss occurs. So that's why they need to be licensed. Secondly, insurance regulators often set financial solvency criteria to make sure that businesses have enough cash and reserves to cover any claims. And in Uganda, we have those levels. You will find out about them. I think they are over $1 billion. I think for insurance companies, should be around 4 billion for you to establish an insurance company. I think below or above, but not less than 1 billion. So the financial solvency criteria is to ensure that these companies, before they enter in business, they are not actually going to begin business with what people have. In fact, they have come to help, so that the first day they're in business and the first month they're in business, the uncertain event occurs, they're able to pay such their client. So they have that rules that govern how much they must have. Just like for the banks, for you to have a bank or open a bank, you must have certain level of amount of money that you should be able to have. So this all is to protect the business of insurance, both the sellers and the clients or the buyers, and also protect the interest of the government, because the government is interested that the business of insurance continues in that way. Some actually are here, like life insurance, just life insurance. If you are to enter in the business of life insurance in Uganda, you must be able to have 3 billion Ugandan shillings just for that life insurance service or insurance. That's approximately 844,000 United States dollars. If you are to engage in other non-life insurance, you need to have 4 billion. If it is reinsurance business, the one we talked of, where you insure another insurance company, then you should have not below 10 billion, and so on and so forth. We also have what they check as the regulation often requires the insurance sector to provide plain and understandable disclosures of policy terms. So they are there to ensure that the terms of agreement, the terms of contract of these insurance companies that they are going to have with the clients are actually clear in a way that there's no confusion, there's no doubt at the end of it, that we know when A happens, B will be done. Not that B may be done, but should be do, B will be done. So there must be in clear terms, not ambiguously stated. Another one is to avoid unjust discrimination and advance affordability. Regulators may keep an eye on insurance companies' pricing and underwriting procedures. They might demand actual support for premium rates and keep a close eye on pricing procedures. To avoid the issue of discrimination in a way that charging people differently, people of the same class, of the same, who are insuring the same thing, you are charging them separately. For example, a Toyota Hilux of the same kind, of the same type, we may not be able to charge them differently. But the discrimination comes when, because the car owner for the other one is a real estate owner, so he has a lot of money, whereas the other one is of a small company, so decides to maybe discriminate. So that's why we're saying there must be backups as to how they charge the premiums. So that's how the regulation also comes, and that's why it is necessary, so that the insurance companies are also checked. They also establish rules for quick and equitable claims management. Of course, insurance companies, sometimes they may not want to pay you, as one of you noted in class that they were not paid. Of course, it is their interest to make profits. When they pay you, that's a loss for them or is an expense. In that manner, nobody wants expenses. Yet those are the same things they insure you against. So the regulation is there to establish that there are rules or there are policies that help the insured to be compensated whenever such losses occur, under the guidelines on how quick they could take place and how they are also managed. And lastly, but not the least, there could be many others. There are many others that the regulatory authorities look at and try to manage. And the last one we're looking at is to prevent anti-competitive activity and maintain fair competition. You know, anti-competitive competition can actually ruin the economy or the sector, the industry, and can actually bring it down and makes it of no benefit or no sense. So the regulatory authority comes in to ensure that the competition is fair. It's a fair competition. That the ones who are well established and have sufficient funds or funding do not push out the others who are in the market. Because these small ones, their existence is to make sure the others also don't overcharge, for example, on the premiums, as far as the premiums are concerned. So a fair competition deals with a type of competition where you also don't speak or tarnish the name or the image of another insurance company. You be doing business but not tarnishing the names of your competitors. That would be very illegal, and actually somebody can be sued for that. And once you are sued, then the government or the regulator authority or the court, once you are sued, can act based on that to charge the other company. So they are there to promote, set those rules of how competition could be carried on. And that is it for the insurance regulatory, the areas they look at. And I've provided actually some brief information about the insurance regulatory authority that we're not going to look at. It's for your personal benefit and for personal use. So you're going to look through when it was established and what are its mission, the vision. These ones you'll do them on your own. The last area we want to look at, hopefully we shall not take much now, is the competition in the insurance industry. So we're saying, like any other market, there's a competition in the insurance market also, and we are basically going to look at the forms at which it presents itself. And one of it is, we're saying that there's price competition, and in price competition, the insurance companies try to charge lower prices than their competitors in order to attract the clients. And usually competition is there to ensure that you prove yourself to be the best, and that could be in the form of lower prices. Another could be in form of quality. So we have quality competition in insurance. Insurance companies compete by offering different types of qualities, as well as offering benefits to the insured by indemnifying them back to their original state in case they incur any losses. So provision of quality service is also one, especially when house catches fire, and the way you do that work at the end of it. And for sure, if it's said that this was indemnified, the house had collapsed, but since there was insurance company of this name that helped us to bring it back, and really the service looks good or the house looks good, then that is also a way of them competing. And of course, by providing different qualities, because people have their choices that they want. So quality is a matter of, or an area of competition for the insurance companies. We have service competition. Insurance is a promise of future performance, and the individuals rarely know if the service he or she has purchased will ever materialize until when he or she incurs a loss. They also offer a range of insurance and their service support. Insurers also offer good customer care services and advice to their clients as a service. So they also offer services to their to their clients. Customer care services. Advising them, being kind to them, being considerate about their feelings and their demands. That is provision of service. And the other part talks about the service that we shall be able to provide in the future. How reliable we are, whether we shall be able to put the storage building that has collapsed, that it was insured, whether we are going to put it. So they try to compete in that. Another area is free gifts. Of course, they offer gifts. This one you're going to give, of course, they give gifts like t-shirts and so on and so forth, umbrellas and so on. Then the location and opening hours of business competition. They also compete in trying to strategically locate themselves where they're able to market themselves. Also in terms of opening hours or the times now they use. For example, others might already be working often on all offices open on weekends or beyond the working hours, or 24/7 they have their service available on online. So such are also a way of competition. We also have commission competition, whereby the agents, they compete in offering, of course, better commissions for the agents. And because the agents are a source of their clients, they are the ones who look for the clients, or the agents, yes, basically. So in that way, they also try to offer better commission rates for the agents. And of course, lastly, innovativeness and creativity. The way they handle their matters can also prove them to be competitive or a competitive advantage. Dear members, I think it's we have taken 1 hour and 30 minutes for this lecture, and I think we should stop here. And I hope you're able to benefit actually from this lecture, and that you were able to do more research, because at this level we don't depend on one information or one source of information. You can find out more information about this topic or about insurance generally. You can find more information. It does not necessarily mean that my information being different from you, you are wrong or I am wrong. It only means that we are growing in knowledge. So hope that we are actually advancing and benefiting from the knowledge that we are getting here. As I said, by the end of this course unit, you're able to know the dynamics that exist in insurance. You're able to know the pros and cons of being insured, and how best the insurance company can be run. You can be able to advise somebody who wants to establish an insurance company what he must do first. Must be registered and so on and so forth, what level of capital they must have, and this requires more effort from you, not just what I have already delivered, but requires more effort from you and me for us to become experts in the field of insurance. So members, that's all what I prepared for you, and hopefully that's the end of this topic also. I remember saying each lecture one topic, and then we shall also next time maybe try to look at the law of agency. The agents we have looked here, we're also going to look at it at more detail, their contract now in terms of the agency contract. So that's for the next time. Until next time, wish you all the best. Enjoy your time. It's time for Salah. I wish to say bye for now and wish you all the best. وهذا السلام عليكم ورحمة الله وبركاته.